Last question. Welcome back to your Mortgage Minute with Tracy Lasserre with Hancock Whitney. Tracy, thanks for joining us.
Hi, thanks for having me.
So we have, one of the things that's been popping up quite a bit lately has been national lenders offering crazy awesome rates, but there's a catch. So how do you check to make sure that you're not getting ripped off by a good deal?
Well, first and foremost, if anyone is quoting you a rate or fees or anything like that, they need to send a loan estimate to you. So a loan estimate is typically 3 to 5 pages, and it will break down all the terms of the mortgage, whether it be just a quote or a true locked-in rate. It'll break down the rate, the cost for the rate if there is one, and all applicable closing costs, and all the figures from the contract if they're under contract. So it's easy to take that document, give it to your local mortgage loan officer so that they can look at it and tell you if it's legit, if it looks good, or they can shoot holes in it and tell you what's wrong with it.
So one of the things too, I've always preached to go for local lenders, because anytime you're dealing with a 1-800 number broker, I don't care where they are. For me, I always like the ability to be able to go into the office, ask a question when there's a problem. On an 800 line, I don't care where you are, whether you're in Ohio, California, Florida, Texas, wherever. I want to be able to have a conversation. So if there's a problem, who ends up having the most patience? The person that's going to get coffee while you're pissed off on the phone, or the one that's on hold trying to wait to be able to make some things happen for you as the buyer? Or the seller, if if we're representing our sellers, trying to make sure we find some answers to some things that are going on. So,
yeah. And so my clients always have my cell phone number. Always. That's the only number I give them.
So
they can call and text me all the time.
At all times. And responsiveness is key. So we're going to jump right in. What we have here, we're going to have 2 loan estimates side by side of an 800 number. And we'll keep all names to save the innocent right here. And of course, the consumer's name, due to privacy laws, everything's going to be whited out. And one other disclaimer real quick, Tracy, as far as rates.
Yeah, so rates are going to vary depending on the day, the time the rate is locked or reviewed, and the borrower's overall scenario. So there are dozens and dozens of factors that affect interest rate, fees, and closing costs. So just keep that in mind.
Perfect. We're going to jump right in. All right.
Okay. On the right, you will see my loan estimate. And on the left, you'll see the loan estimate from, let's call them Pocket Mortgage. Okay. I'm going to start from the top and we're going to work our way down, and just stop if you have questions. So the sales price on this property is $285,000. You'll notice that the loan amounts are different. My loan amount is lower, so my buyer is bringing 25% down. Now, based on my interview with them initially, they told me they wanted to bring X dollars to closing total. That's with down payment and closing costs. So that's what I base my cash to close on. They spoke with the other mortgage company, and that mortgage company gave them other options. Now, other options don't always mean that that's what's going to be best for the borrower. That also doesn't mean that the borrower is actually going to qualify for that. Whenever I get a loan application, I do a very thorough review. I basically pre-underwrite the file. I get all income and asset documents up front. So you have a true pre-approval, not just a pre-qualification where I pulled credit, looked at the income that the borrower put on the application, and I say, oh yeah, that's good, let's go. I go through this with a fine-tooth comb, because the last thing I want to do is look at a borrower or the realtor, both of them, and tell them, I'm sorry, I messed up. They no longer qualify for what I gave them a pre-approval letter for.
After inspections and appraisal and all that other fun stuff.
After they've spent all that money on all of those things.
So let's jump in. We got projected payments, and the first thing that jumps out is, obviously you got mortgage insurance, which they would have to pay because they put less than 20% down.
Right.
And the other thing was the escrow. So you see 204 on the left and 417 on the right.
Well, and let me start at the top of the interest rate. Okay. So my interest rate was 7.125. Theirs was 6.99. And now let's go to the payment. Keep that interest rate in mind though. Okay. So monthly payment with the other mortgage company, they were putting 10% down. So at that point they will have to pay PMI or mortgage insurance on a conventional loan until they reach 20% in equity. So if you factor $120 a month times 12 months times, let's just say 10 years, worst case, they're going to pay around $15,000 ish for mortgage insurance, which they wouldn't need to pay if they put 20% down. Now, if they don't want to put 20% down, that's fine. But with the rate, when you have PMI actually mitigates risk for the lender. So typically, the rate when you have PMI versus when you don't will be about 1/8 of a point better. So first of all, that's one of your differences in the two rate options here.
And jumping into immediately, one of the first questions that I ask my buyers is, yes, if you got a quote unquote better rate, what was the cost? There's a couple of different costs that are attached to be able to get the rates. We call them discount points. We call them points. We call them origination. There's a lot of creative ways.
Yeah.
Because people are accustomed, or consumers are accustomed to hearing origination, and that's like a bad word. They've heard of discount points, and that scares realtors off. Now the new one is points.
Right.
So you can see right here under A towards the bottom of the screen, $6,733 was 2.625 points, which is the cost to bring the rate down from whatever they were to 6.99 versus 7.125. And Tracy's has 0 points. If you can look under line A, closing cost details, loan origination charges, $1,236. That was their lender fees. The lender fees for the 1-800 number,
$1,500
end up being $1,500. So they're a little bit more. They're a little more expensive on their fees. Plus, they cost an extra $6,733 that was not charged to be able to get that rate.
Right. So going back to what you asked before, too, the escrow and the taxes and insurance. If you look at the two where it says estimated taxes, insurance, and assessments, this is escrowing property taxes and homeowners insurance. Mine is 417. Theirs is 204. So
Why would that be?
In no way, shape, or form will you ever have taxes on a $285,000 purchase at $40 a month in Acadian.
And just so you guys can see where that number is coming from, the homeowners insurance would be under G.
Page 2 of G, yeah.
Page 2 under G, under other costs, G, first line, $162 a month. On G on Tracy's page was $292 a month. This was actually,
124.
I'm sorry, $124 for taxes, $41 for property taxes on G for the 1-800 number. So these numbers were actually pulled, you pulled them from the assessor's
verified
page.
these based on the purchase price, based on the borrower scenario, homestead exemption, blah, 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 sales price. This is as close to I could possibly be on property taxes. Same thing with homeowners insurance. I shopped it. I helped, I gave out a few numbers, got a few quotes, send them back to the borrower so they could look at it. And I told them, I said, look, you can get insurance from whoever you want. Keep me posted. This is to give me a frame of reference on what insurance will cost. And based on what I see, insurance will cost you approximately $292 a month.
So close to double what the 1-800 number comes. So, which, by the way, anybody that's shopping around on homeowners insurance, if you've done this within the last 3 years, you've noticed that rates have increased dramatically since Hurricane Laura and Delta, and the increase of all that's been going on. So this number, we know $292 for homeowners insurance. It may not be the absolute bet, we didn't cover every single agent out there, but we've got a good representation for quotes that were given. So, but it's definitely not double for sure. Yeah. So when we scroll back up and we take a look at what the payment ends up being, you've got PMI at 120 plus $204 a month. They were off on their escrows by $213, which would end up bringing your total payment to $2,241. So almost $400 a month more, along with the extra costs that are involved with, because what ended up happening, not only are they off on their their homeowner's insurance estimate, but they were also off on multiple other. That also ends up bringing your total amount of
It's a domino effect.
closing costs
Right.
up.
Right, because your insurance premium is going to be higher, and your escrow, the amount that you're going to have to put in escrow is going to be higher because those numbers are wrong. I would rather overestimate on a loan estimate than underestimate all day long. I'd rather give good news than bad news.
So what's the advantage? So whenever you're calculating, we know what the closing costs were. We know that they were high on a multiple of fees. If we're not going to go line by line on each one on A, B, and C, but other costs, all of these, walk us through what that happens to bring if you're having to bring this to closing.
As far as
like the adding them up, closing costs plus.
Oh, right. Yeah. So if you look at my loan estimate on the right versus theirs on the left, and total up all the closing costs and then the prepaids, the difference between the two, even though mine are right and taxes and insurance are higher, I am still over $4,000 less because of their huge 2.625 cost for to get the rate. That's just an eighth of a point lower than what I can do.
I did the adding for us.
Okay.
So your total other cost, which is line I, $48.95 versus $78.78. The difference is they were assuming insurance was less than $2,000 a year, which, by the way, it's not. They assumed that the escrow for that was $162. We already know that's double, so that means this is double.
Right.
$41 a month is off by 70%, so that is going to increase. The title insurance, that's the one. This is actually one you also verified, so they're also off by $140 because we have local title companies that we actually speak to. 1-800 numbers don't have those
Right.
relationships with local
Right.
companies, so we know
So
that this is
total all
going to
in,
be in. So total all in,
$4,000
instead of $48.95, it should have been somewhere in the $88.95 range, which would bring your total closing cost to over $20,000. Here's where the wow factor ends up jumping in. So they saved on 1/8 of a point. They saved on 1/8 of a point, which on this loan estimate, I don't have my calculator up in front, but it ends up being $20.64 a month. So $20.64 a month divided by $10,000, which is how much more expensive it was to buy that 1/8 of a point. You're going to be in this house for almost 2 lifetimes.
Yeah.
It's crazy.
And the total extra cost with the rate buy down and the PMI is around $21,000 roughly. So the point of all this is we look at this every day. Consumers don't. It can be very confusing. You think it looks good, but there's so many other things to look at that, like I said, we look at every single day. So we can review it for you and give you a very honest opinion on what we see. And like I said before, I interview my clients in advance, so I know exactly what their goals are, what they're comfortable with from a monthly payment and out-of-pocket standpoint, and that's how I tailor their loan.
Of course, and I also want to make sure that I add to, I don't blame these borrowers for making a decision based off of shopping for the lower rate, because the devil's in the details whenever you start digging through this stuff.
Mm-hmm.
If you start peeling back, if you don't know what to look for, which we do, a true professional in the real estate industry does, we're going to know exactly what to be able to look for to see where you are getting taken advantage of. Just to go back, I just ended up doing some calculations right off the top. It ended up being 484 months to be able to catch up $10,000 over the course of $20.64 savings, which is 40 years.
Yeah, it's a long time. But looking at all these numbers and all these forms is very confusing. And that's why it's important to have someone put their eyes on it. And for me, if I look at a loan estimate and it's better than what I can do, I will tell that client, hey, take it and run. This is great. But if it's not, I'm also going to be very honest and let them know this isn't one, what you want, and two, these are the issues that I see with it. Why. Let's talk through it. Yeah. So I like knowing the why behind things. So I like telling people the why behind it. That way they can better understand. And at the end of the day, they will feel better about the decision they made with the loan officer they went with, the bank, the product and program and all the details dealing with their mortgage.
You know, I think it's another thing too. This is not a because I said so, it's better. There's going to be some reasons and some numbers to the why that's going on.
Right.
Like none of us are, you know, in middle school or elementary school getting grounded from doing things that we weren't supposed to do. We need to know the why of what the mistake is. It's why, you know, why you're making the decision that you're making. You know, it could have been from loyalty. It could have been because you got blinders on for the rate.
Maybe
being
you had a good
absolutely
experience
amazing.
before, and that's fine,
Yeah.
you know. But things change, and I'll tell you right now, in the climate that we're in, everybody's scratching for business in real estate. Everybody's doing what they can to put something, wrap it up, and put a nice bow on it to make it look pretty. But you've got to open that present and see what's inside to see if you really want it and to see if it's really good for you.
In that case, this one was a big old box of rocks. And thankfully, we were able to go and see that
Right,
and go through
early
it
and catch it.
and catch it. But, you know, consumers, I will tell you, the biggest thing, buyers, I will tell you, if you guys are shopping around the rates, talking to your lender and saying, I've got X and Y and Z, we can't really help you understand what's going on without being able to see the paper to help you dig into why, because, you know, you may be coming up with less money to close, but as we found out just a little while ago, you know, just by going through here, we start digging through all these numbers. We know that 1950 is wrong. We know that 1295 is wrong. We know that the escrows are going to be off. We know the owner's titles are going to be off, and all of these services right here on the left-hand side, if all of those are short by, you know, a couple $100, that adds up so fast
Yeah.
to where you end up bringing even more money, and you just, you know, at
It
the end of the day,
doesn't
we
look
got
like
the
look
best
like
interest
you are,
at
but
heart
right.
for you. And
Yeah.
it's never been because we don't want somebody else to get the deal. It's all about, can we get the best deal for you and keep it in house so we can actually make something happen if there's a problem that pops up.
Well, at the end of the day, you don't want to get to the end of the deal with your client just
And
for
then
them
it
to
fall
find out
apart.
they have issues, and you're like, oh my gosh, now I'm scrambling.
Or they
Almost
rubber
had a
stamp a
contract.
pre-approval letter and didn't check to see if they even made the money that they said they made. That's something
Right.
that's
There's
super common
so
too. And
many,
it's so
many
frustrating.
things that we see that happen with those lenders. And another thing too is I need to not screw up, because if I run into this buyer at the grocery store, I need to be able to look at them and tell them hi. Or my realtors, like I can't do a bad job on my files and go out in my community and see these people who live and work with me every day.
But by the same token, that 1-800 number loan officer, you will never see them again or even know what the hell they look like. And that's not okay. So Tracy, thanks for jumping in and looking through the matrix that is all these numbers. I know it's super confusing for a lot of folks, but hopefully we're able to shed some light.
Yeah.
Where can they find you?
Tracy.Lacer@HancockWhitney.com.
Awesome. Looking forward to jumping in next time. Thanks so much.
Thank you.